QuantSpeak, expert insights from quants for quants.
Welcome to QuantSpeak, a new podcast from the CQF Institute at Fitch Learning.
Hi, I'm Dan Tudball, editor of Wilmot Magazine, and this is QuantSpeak. As we record this today, we're just a few weeks out from the first Quant Insights conference of the year, which will be looking at portfolio management in quant finance. The event is on the 23rd of March, and naturally, this is something you should be attending. Our guest today, Renee Yao, will be participating in a panel on developments and applications in explainable ML in portfolio management. A particular focus of the panel will be on explainable machine learning, XML, in the context of portfolio management. XML refers to the ability of a machine learning model to provide clear and transparent explanations of its predictions and decisions. This is becoming increasingly important as more and more financial institutions are using machine learning algorithms to make investment decisions. The discussion will explore the current state of XML in portfolio management, especially trust in the decision-making process, as well as its limitations. Renee Yao is the founder of Neo IV Capital Management, a quantitative hedge fund manager, now in its 8th year, that focuses on trading liquid, publicly traded equity securities via artificial intelligence strategies. Welcome, Renee.
Thank you for the kind introduction. It's my pleasure to attend the conference and share my view and how to apply that in our trading into the financial market.
That's great, Renee. Thank you so much. It's the portfolio management conference has really become sort of a cornerstone of the annual program, and it's always very well attended. And I think that this particular panel is really going to be an interesting one for the audience. I wanted to start off right at the beginning, really, professionally for you. You're a graduate of the University of Kansas and have an MA in statistics from Columbia. Can you tell us a bit about the motivations behind your taking that academic path and when it was that you decided a career in finance was for you?
Yeah, when I entered Columbia for my graduate study, my goal is to become a professor in applied math field. However, because Columbia is based in New York City, so naturally there are so many information about how financial market works, including both the Southside banks and the hedge fund. And then the third year during my study, I received a call from a recruiter asking if I'm interested in interview one of the top hedge fund. Because I'm curious about how the hedge fund world works, I said, yeah, why not? And then I started my first job from Citadel.
Right, and what a place to start. You were saying that you were actually sort of more inclined towards an academic career at that point when you were actually studying. And it's really sort of, I mean, what you're saying is it's basically an environmental factor, just being in New York, that opened up that opportunity to you. But that leaning towards an academic approach to things is something more than a professional choice. So what would you say, was there something within you that sort of wanted to teach, wanted to research, perhaps?
Yeah, sure. So I've been always interested in learning how to apply what I learned at school into the application of the real world. So that's when I learned how, say, some of the hedge fund funders, they were able to apply what they learned from school into the trading and actually realize that becomes so fascinating to me. A career path as academic professor is definitely something similar. However, it's more on the theoretical side, where a career on Wall Street is sort of doing something similar, however, on the more practical side. So it's easier to see how to see an immediate result from what you learned. So I think that's what makes me more interested in how to apply what I learned in school into the real financial market.
Absolutely. You've described yourself as a third generation quant. What is it that you think you have inherited from the first two generations?
That's a very good question. So when I entered Citadel, I would say we're still a second generation quant in the sense that we're trying to learn from a lot of historic data and see if there's any patterns in the historic data. And hopefully the same pattern will still hold in the future. So that's how we learn to generate new alphas, new ideas in our quant trading back then. However, what we are doing currently now is different from that in a sense that instead of relying on human power, trying to come up with new alphas, new ideas, we are training this AI system. So the system will automatically come up with new alphas and new ideas for us. And that's the main difference between the second generation quant and the third generation quant.
Let's talk a bit about that first job at Citadel. What a place to start. And what sorts of learnings do you think you've taken from that experience that's informed the rest of your career trajectory?
Sure. Of course, I learned many things from Citadel. I think some of the most important aspect is how to run a portfolio, how to control your risk, how to evaluate your risk exposures and downside protections. All of that portfolio construction skills together with the method of how to come up with new alphas, new ideas are what I learned and great knowledge I've inherited throughout the entire of my career.
So NeoIV's been running for about 8 years now. Congratulations on that. That in itself is an achievement, right? So tracking back, you would have entered the markets around about when you graduated and entered Citadel. Which year was that?
2010.
2010. So at that point, we were 2 years into the global financial crisis. The paradigm had shifted for quantitative finance thinking. We can sort of see 2008 as a sort of a wall that delineates two very distinct phases in the development of quantitative finance, the application of it. That period prior was very much sell side led in terms of innovation. It was that period before 2008 was very much about structured instruments, about exotic products, and so on. That period after 2008, which we are still in that mode now, we're having to deal now with the inflationary aspects of the economy post-COVID and so on. But we can still see a definite line from 2008 to this point. There's a definite narrative there. Part of that narrative was very much the rise of the significance of machine learning and artificial intelligence throughout all industries. And as an observer, the way in which that has penetrated the consciousness of the financial industry has been very interesting to observe. There have been a lot of motivational factors that have assisted the rise of the adoption and faith in machine learning as a way forward. When was it that you personally realized that machine learning was going to be a game changer for finance?
Yes. So I think machine learning sort of becomes a buzzword for today. Like everyone manager is claiming they're using machine learning. But if you think about the history of machine learning, like the very elementary machine learning probably dates back to 1950s, where people use simple mathematical skills like principal component analysis, logistic regression to try to train a computer to find some patterns in the historic data.
Sure.
And then later, there are more sophisticated approach like support vector machine, random forest, artificial neural network. All of that are what we consider to be traditional machine learning approach. Like a good example of that approach would be IBM's Deep Blue algo, an algo designed by IBM for the Russian chess game. Now, the difference of the chess game compared to the Go game is for chess game, you have finite possible solution set. So you can literally use the machine to do a brute force search to help you navigate all possibilities, and then you can pick the highest winning probability one. And however, we know that's not how financial market works. Like the financial market has infinite possibilities, just like the Go game does. So that's why we consider when Google published their AlphaGo paper in 2016, we consider that to be a real game changer in the AI or machine learning history, because that's the first time when the researchers were able to train the machine to truly think and analysis like human, instead of just do data mining or pattern recognition from historic data. So that is in my personal experience when I feel that machine learning or AI could be a game changer.
Now, your background was in statistics. To rewind a little bit, as an observer, one of my observations about machine learning and the community of researchers that has grown up around that has been empowered by industry interest. One of my observations is that there seems to be a relearning process for people who are machine learning researchers per se, that when you look at fora for machine learning researchers, a number of questions come up about things which require the answer actually already exists in the context of traditional statistical research and so on, the history of financial research. So in terms of the relationship between the application of machine learning and those who apply it now, and the heritage of the field of statistics from which you come, how do you see the relationship between the two? Do you see machine learning as a natural progression for statistics, a tool, or do you see it in some other way?
That's a very good question. I definitely think there's some heritage coming from traditional statistic approach. For example, naive Bayes model, like a very elementary statistical kind of approach model, but it kind of start the fundamental learning methodology in terms of how machine learning works. Like you have to train the machine with a lot of historic data, and you hopefully find some patterns in the historic data by training the machine. And then hopefully the same pattern that the machine recognized from the history will also hold in the future. So that's how kind of traditional statistic model works. Now, some of the modern machine learning technique still hold the same pattern or still hold the same learning methodology. for example, like artificial neural network or random forest, they will follow the same learning pattern in the sense that they're still looking at historic data. They're still hoping there will be some pattern recognized from the historic data, and the same pattern will still hold in the future. So that kind of inheritance from the traditional statistical kind of approach definitely goes through the traditional machine learning methodology as well. And even in the modern AI space, I would say part of the AI learning is also from looking at historic data. Like, for example, in Google's AlphaGo paper, which they published in 2016, they use a combination of traditional machine learning approach, which is looking at humans' historic Go play record, and combined with this modern AI approach. Now, in 2017, in another paper they published, which is called AlphaGo Zero, they no longer use any historic human play Go record, and instead use this pure analytical learning ability to teach the machine how to play the Go game. So you can definitely see a history or of patterns from the evolution of the machine learning methodologies.
I think that's a good point at which we should move to the topic of the panel that you're participating in. Can you walk us through the issues around explainable machine learning when it comes to portfolio management?
That's a tough question. Now, one of the biggest challenge for AI is its interpretability, meaning how do you explain why the machine makes such a decision? Like, for example, during the AlphaGo game versus the Korean Go championship, the 37th move, almost all the top Go player don't understand why the AlphaGo algo decides to make that move. However, later that move has become a very important milestone in deciding the result of the game. So that has been a similar challenge in applying AI in the financial market as well. If you ask me exactly, like, what kind of factors are there, or what are the weight of each of the information we put into the AI models are for each of the different AI models, I wouldn't be able to tell you, because if I do, I don't need to run this sophisticated machine learning algos. I can simply run a linear regression and tell you what are the contributions of each factors. The power of AI is to be able to realize that certain informations are not interacting with each other in a linearly fashion. It's just like how our brain structure like it's a net structure, and each information can have interactions with many other different informations. So it's not exactly linear. Instead, it's a net structure which is more sophisticated, and that's why difficult to explain as to how each of the informations are kind of display or interact with each other. However, that's just the nature of AI, or nature of how our brain structure looks like. We just have to kind of understand on the high level why certain informations are useful by the AI algo and why certain informations are not useful. And I think that will be sufficient enough to give us some comfort as to why the AI algo is making certain decisions.
That's a very pragmatic answer, I think, and pragmatism really ought to be the cornerstone of finance, really, given what we're dealing with. Do you think that it's more of an issue for people who is more of an issue sort of for the boardroom and the auditor, rather than the researcher themselves?
That's a tough question to answer. I think in general, people tend to deny the things they don't understand, right? Like if we are learning something new, we would naturally feel uncomfortable in accepting it. However, as more and more applications of AI has stepped in our life, changing our daily lives, like the Chat GPT, like the Tesla's auto drive, people began to more and more realize how important AI is, and that's become more acceptable for some of the shortcomings for AI, like interpretability.
And I'd like to talk a little bit about the fact that, you founded Neo-Ivy, and the decision to go ahead and set up your own firm, it can't have been taken lightly. What are your reflections on that period in your career? Because I'm sure many of our listeners are also interested in setting something up for themselves at some point in their futures.
Yeah, absolutely. The decision to start your own firm is never easy. There are so many factors to be considered. What's driving my decision back then was we are truly a believer of the modern AI and its applications in the financial market. However, the concept was not easily accepted by some of the traditional quant managers, nor the infrastructure would support such approach. So in order for us to truly implement what we believe, we have to build a whole system from scratch, which is completely different from the legacy system that are widely existed at some of the second generation quant firms. So I think that's why that ultimately drives our decision to set up our own firm.
As a woman in finance, what's your take on the current environment in the industry for women in comparison to when you started out?
Well, I always love to see more women come out and become taking more senior positions in this financial business. Whenever I go to a conference or say a seminar, there's always more male participant compared to females. So that's why we think women and minorities are always underrepresented. So we always encourage and try to do our best to promote the women and minorities to pursue their dreams and to facilitate their career in the financial market.
In that regard, I mean, over the last decade and a half, were you fortunate enough to have role models yourself within that definition? Who would you point to as people that you admire in the industry that are representative in this more open way?
There are definitely many role models and definitely many good examples in terms of female managers that I look up to and learn a great deal from. I probably wouldn't name them before getting their permissions, but I would
Sure.
yeah, but I would say there are many successful female leaders in this financial market, and a lot of the organizations also helps promote women and minorities. Like today, a lot of the pensions and endowment like investors would have this diversified program, DEI program, ESG program that would help the women and minorities. And we have many associations which are designed for women and minority managers. I think all of that can be very helpful in promoting women in this business.
Thank you very much, Renee. Final question. In terms of the panel that you're going to be participating in, firstly, what was it that drew you to actually agree to participate in the panel? And secondly, what do you hope that the discussion is going to be able to provide in terms of takeaways for the audience?
I've always been a believer of AI and its applications in the financial market. So I would like to share my view in terms of how we can apply AI in the financial market. And because AI is a very new subject and very new technique, many people, like every people will probably have their own different opinions. So I would like to share and exchange ideas with my fellow practitioners in terms of how they view AI and how they could apply AI in the financial market. So that's what drives me most in terms of participating in this conference. And of course, it's been an honor to be invited to be part of the panel. And because I know you are a very well-respected organization as well. So thank you for giving me this great opportunity.
Thank you, Renee. I complete aside, actually, just to do with AI. Probably about 6 months ago, I started to wonder what effect AI was having on my hypothalamus. Because this is just in the context of using Google Maps for driving. And I remember maybe about 8 to 10 years ago when I first started using Google Maps for driving, I used it as a sort of a form of competition between myself and the algorithm, because I just wanted to see whether or not I could actually get to the location faster by using a different route than the one that was actually recommended by Google Maps. And in the early days, I actually found that there were a few occasions when I actually could beat the computer. But then over the years, I found myself more and more dependent on the navigation. And then about 6 months ago, I realized that in comparison to how knowledgeable I was about the general surroundings and the general geography of locations that prior to that I had been very familiar with, didn't exist anymore. And so I actually stopped using Google Maps. I would use it before I set out on my journey just to check the traffic. But then after that, I would go ahead. And it was funny because I don't know if it was pure coincidence or not. I felt like I was picking up much more useful information on my journeys than I was when I was using navigation. So although the algorithm was helping me to achieve my primary goal, which was to get from A to B, I had definitely lost perhaps what you might call associated information, which I would actually use in the context of future journeys, and also the overall appreciation of actually being immersed in the real world rather than feeling somewhat like a cybernetic organism, which was utilizing skills, or rather outsourcing aspects of my own mental resources, like my hypothalamus, for example, to the computer. As a person who works in artificial intelligence and so on, do you think that this is a valid observation about the trajectory that we're on?
That's an interesting observation. I think I would definitely agree with you on some aspect of that, because what AI is doing, in our opinion, is trying to automate the human's learning process. So in a sense, we're not hiring hundreds of people trying to come up with new ideas, but instead we're training this AI algo to do what the human used to do. And of course, the AIs would have so much advantages compared to human, like they are much faster in terms of computing speed. They can work 24/7 nonstop. However, there are many things that we wouldn't do without, like we would have to do ourselves without the existence of AI. So that can be pros and cons. But in my experience, I think in general, the application of AI does make my life much easier. Like, for example, if I want to run a quantitative hedge fund using the traditional second generation quant business model, I probably need to hire a large team size in order to maintain my long-term sustainable growth, to keep my competitive edge. And also I probably need to have a large, say, AUM base in order to support a lot of the operations and data cost. However, with the help of modern AI, we are able to run New Ivy at a very efficient way, so that we don't need to maintain a large, say, AUM size in order to keep the business running for long terms. So I definitely agree. There are things that we give up through applying AI, but in my experience, there are definitely more that we gained by using AI. So that's why I believe that AI could truly be the future of financial investment.
Absolutely. And I think that is inevitability. Absolutely it is. Thank you once again, Renee. To our listeners, the conference is coming up on the 23rd of March. It's free for CQF Institute members to attend. And as I always remind you, membership of the CQF Institute is free as well. So you really have no excuse. And if not, the algorithm will find you and it will bring you along by force, I promise.
Thank you for listening to QuantSpeak. Don't forget to subscribe and do sign up to the CQF Institute for more insights into quant finance.